we'd like to bring up our other panelists to give sort of a variety of views. We're coming from a few different perspectives here. We have people who are themselves public companies. We have a private company that may aspire to be a public company. We have venture capitalists that invests in companies and hopes to sell them someday, often in the public markets. And we have an investment banker who advises companies, but in many cases might make their biggest fee from an IPO. One thing that struck me about what Tom said is that he doesn't seem that concerned about the state of the IPO market, and I guess I wanted to see time will heal some of it, and that maybe it doesn't make sense for all companies, and that's okay. So I guess Howard, I wanted to see, as a venture capitalist, are you as sanguine about the state of the IPO market? Do you worry that companies that you invested in an early stage are just going to be stuck private forever and you'll never see your money back?
Howard Morgan at First Round Capital. We are a little worried. I was in the venture business since the early 80s. And in the 80s and 90s, we took lots and lots of companies public. Small technology companies, 50 million in sales, maybe profitable, maybe not, went public to get capital to grow, to get their shareholders and their employees who had been with them, for 5 or 6, 7 years to get liquid. And there was a robust market which included a lot of retail investors to keep the things trading. And then it made it very good for the venture business because we could be in companies and we could exit either through M&A or through IPOs. First Round's done about over 300 investments since we started in 2005. And we have 3 companies that are public and Square, which is now filed to go public. And our largest investment, Uber, is having this dance about whenever, if, because they're able to raise such enormous amounts of money in the private markets. But it's worrisome for our much smaller companies, which most of them are, because the only exits are then M&A exits. And M&A exits are not the right level of price discovery that the robust markets we had in the 80s and 90s had. And when you get the Fidelities and the Wellingtons and T. Rowe's making the market in companies, price discovery is very different than the everyday price discovery that goes on in a high information market. And I think Tom was right in the point of there's a lot of trust in the public markets because the regulations mean that information that's coming out is correct. And there's high penalties if it's not correct, legal penalties. In the private markets, the information is much more hidden. It's not nearly as clear to not as many people, and price discovery may be quite wrong. And we've seen busted IPOs, tech companies that go out and are high for a little while and then drop, sometimes for no good reason, sometimes for good reason. But it's definitely worrisome. We would rather see more companies be able to access the public markets to get their employees the benefits of their labor for the 5, 6, 7 years, and the investors.
So, given that, Sean, when you're talking to a company that's thinking through its options, are you advising them to hold off on an IPO right now, or are you trying to, find new ways for companies to get public faster, or do you think that we have the right balance right now?
Sean Madnani, I'm a senior managing director at Guggenheim Partners. I'm an investment banker. So Telis, it's a good question. I think my role is not just a facilitator of bringing capital to companies, but also an advisor, as you mentioned. And I think it's really a function of what a company is looking to achieve at the end of the day. Some companies certainly want to go public because of visibility, or they want liquidity for their investors like Howard or their employees, or they want permanent capital vehicles. It depends on what their objectives are. Other companies may not be well suited to go public, either because of their size, because of their business profile, their earnings or their revenue may be lumpy in nature, not suited for the quarterly swings that Tom was talking about or John had alluded to in his opening remarks. And so it's really a function of the business and the objectives that a company's trying to reach. I don't think that the public markets are necessarily suited for every business, and there is a profile of a company that is well suited, and there are certain companies that are just not well suited for it.
And how does it affect your business if companies don't go public? I mean, obviously, investment banks have for years made good fees on IPOs. What events do private companies have that sort of make it profitable for you to continue to work with them?
Well, this is the first time in many years I've actually heard someone worry about an investment banker's profitability, so thank you.
Well, you're up here, so we thought we'd be polite and ask.
I feel great about myself once again. Look, the truth is that we as capital facilitators and advisors can make our living in many ways, not just taking companies public. And I think there are ways to access capital through private markets, as we've been talking about, or through M&A activity where companies combine that may be better options. And so it's a function of looking at the decision tree and a company's objectives and its profile and being able to advise them in the right way, not simply just forcing a solution on them. That said, I think that at certain points in a company's life cycle, accessing the public markets is very appropriate and something that companies should always think about and keep the option open. I like to advise CEOs and entrepreneurs that they should run their company as if they will be public at some point in time. You can't run your company for, let's say, a buyout or some other very specific objective.
So, Howard, is representing a public company. You guys are obviously OnDeck is a business built around sort of a long-term shift in how business financing happens. So you're thinking about not just next year, but 5 years down the road. And you guys actually went public, or maybe more than that. You went public at a actually relatively early stage, about 7 years after you were founded. As we mentioned before, the average company is about 11 years. So tell us a little bit about your decision to, how did being a public company match up with, because we hear, as we talked about before, being public makes it, you're focused on the short term. You're thinking long term, but you decided to go public. Tell us about kind of that decision.
Hi, everyone. Howard Katzenberg. I'm the CFO of OnDeck. We are the leading lender to small businesses online, and we went public, as you said, in December 2014. So in terms of our decision, why did we make the decision and why then? I think for any company, there's no rule of thumb. It's really circumstantial to kind of the dynamics around that company, its existing shareholder base, and really what they want to accomplish in terms of that long-term strategy. And for us, it came down to three basic questions. One, should we go public? And you don't get to the other two questions until you can affirmatively say, I want to do this. So, I think that's just a cost-benefit type of analysis. And for us, we looked at what are the benefits of being a public company for OnDeck. Our customers, we sell financing solutions to small businesses. Trust and awareness are very important factors in terms of these small business owners deciding what loan to take, which company to take it with. So we knew, given the increasing competition in the space, that over time, both trust and really brand awareness would be important. And how great it would be if we can say, well, look, we're a New York Stock Exchange traded company, and really help build up the credibility by being a public company. So that was one benefit. Second, in terms of how we acquire customers, a big channel of ours is actually acquiring customers through big strategic partners like Intuit, like big banks. And we knew the deeper we would get in terms of integrating with those companies, the more important transparency would be, and also being a type of public company that they could trust. And we've seen that in our partnership pipeline. The fact that we're public certainly helps us win more deals. And then, I think thirdly, as a capital markets company, we're not just listed on the New York Stock Exchange from an equity perspective, but really from a debt perspective, we need to raise money so that we can lend it out to our customers. And given the transparency of being a public company, the stability around it, we believe that ultimately we achieve lower cost of funds and greater capital access as a public company. So for those reasons, primarily, we decided we should be a public company. And after we made that decision, well, you also have to weigh with the costs, the increase, kind of the headcount that's required in accounting, legal, the increased regulation that you have, as well as the opportunity cost of doing a private round. But ultimately, our board kind of made that decision that we should be a public company. And then the next question you want to answer is really, can we? So with respect to can we, I think you want to think about, the controls you have around the financial reporting, the visibility you have in the business in terms of the financial performance, the management team. You really want to make sure all three of those things are really in place before you go public. And, in December 2013, a year before we went public, although we had identified the fact that it would probably be a very good thing to start preparing to be a public company in the long run, we weren't ready. So we spent a good 12 to 18 months really preparing for being a public company. And by the time we went public, and really the 1 or 2 quarters beforehand, we were acting like a public company, doing mock earnings calls, and really having the infrastructure in place from a financial reporting perspective and a governance perspective that a public company would have. So anyway, once you can answer that question, we should, we can. The question then is about timing, and I think then you just really want to look at kind of market conditions, ensure that it just makes sense from a timing perspective.